Okay, welcome everyone to the first of, I hope, many IC Select webinars. We've joined quite a few others, but this is the first one we've run, so I hope it runs well. Thank you for joining. A brief introduction. My name's Donny Hay. I'm a director at IC Select. For those of you that don't know me, I'm joined by Peter Dorward, our managing director, and Jenkins, our very able business analyst and technical support person today. A few housekeeping points. I think Jenkins has put you on mute, but you can chat and you can put questions up for us. There will be 3 polling questions, one coming shortly and 2 during the course of the presentation. And if you do get cut off, what we find with Zoom, it's usually a Wi-Fi connection that's not right. Just come out of your Wi-Fi, go back in, and it should Zoom should throw you back into the call. We'll try. We've had some questions already before the webinar from some of you, and we'll certainly seek to answer as many questions as we can. If any of your questions, whether they've been put before or during the webinar, we're unable to answer, we'll answer them separately, directly and individually to you. The webinar is being recorded, so we will be sending out a recording afterwards for you to share with others. So Jenkins, do you want to put up the first poll question for all the attendees, please? So I'll give you 20 seconds to vote, or Jenkins, you can tell me when most people have voted. But the question is, how did you set your strategic investment objectives for your advisor? That could be investment consultant or fiduciary manager. And it gives you 4 options in terms of the approach you took. I think we should just show the results, and I'll pass over to Peter to comment on them and start the presentation. Thank you.
Thanks very much, Donny. So where are we? So 31% took an approach tabled by the advisor. Took in line with the TPR. Second, 38% took an approach tabled by the advisor, a different approach to the TPR. And third, trustees setting their own objectives. Interesting that a third of the audience, the third of you, set your own objectives, which is great. The other 2 is what we have been seeing, and so that sort of matches our own conclusions really from the marketplace. Interestingly, nobody's received a support from any third-party evaluator. So I'm going to close that. We're here today then to talk about measuring strategic objectives, and that's probably a relief for you, because that's what you were expecting. And that is what we're going to cover. And if Jenkins, if you can move on to the next slide, please. You'll see that we just really put this up as a reminder for you. So you're all familiar with the CMA review, the CMA final orders that were released last year. You will also all remember the pre-Christmas rush last year as well, not to get around and get Christmas presents for the festive period, but to agree your strategic investment objectives by the 10th of December. So this was recognizing one of the key findings from the CMA's review and the FCA's investigation, that you as trustees, or those of you who are trustees, just didn't really have the tools necessary or the information necessary to be able to challenge your advisors effectively on an ongoing basis. Setting strategic objectives allows you to do that, but it is really only a starting point. What you also need to ensure that you're doing is to measure those objectives to make them really useful. That's what we're going to talk about. The sort of framework that you can work towards to be able to measure those effectively. Next slide, please. You'll all be familiar with this, the Integrated Risk Management Framework. This is the framework, the picture of the framework lifted off the regulator's website that you'll be familiar with, you will be focusing a lot of attention all of the time, but particularly now, on all three legs of this framework: covenant, funding, and investment. But really, if you think about it, which of those can you actually influence readily, certainly in the short term? Is it covenant? Well, not really. Covenant and the impact on strength of covenant at the moment is what it is. You can't do anything to change that. You can get your covenant advisor to give you some guidance on it as to what the impact might be, but you can't really change it. Funding level, similarly, you can understand the impact of any change in strength of covenant, potential impact on funding of changes to deficit repair contributions or holidays for those contributions. But again, you can't really influence what's happening to any degree. Where you will be focusing a lot more attention and where you can really begin to influence things more readily is on the investment aspects. And it emphasizes even more whether you're considering advice and additional advice from your investment advisor, or you're overseeing actions that are being taken by your fiduciary manager because they're delegated to do that. It emphasizes the imperative of focusing on getting these strategic investment objectives right and getting the measurement of those objectives appropriate and correct to help guide what happens going forward. Moving on to the next slide, Jenkins, please. The second question really then relates to what should you be measuring as a key financial aspect of that. We see a variety of different answers to this question, the quality of which is sometimes much better than others, significantly better than others across the piece. And often we'll be focusing, in the majority of cases, on changing funding level. And of course, change in funding level is what trustees are really focused on. And of course, that is where they should be focusing their attention overall. But where can the advice add value, and where can a fiduciary manager actually add value to achieving that? And that is an investment return relative to liabilities in our view. Other things change funding level. Liability assumptions, mortality assumptions, contributions, payments out, benefits, transfer values in particular, of course, can impact that dramatically as well. So all you can really focus your strategic objectives on for your advisors or your fiduciary managers is on the investment return, what they can really impact. Next slide, please. Now, I said that we were here to talk about a framework for measuring, and we are, and I will get to that, I promise. But before I do, there's an important question to ask of you, or for you to ask of yourselves. That is, what do you hope to gain from these strategic investment objectives? And we've put here three options. There will be more and variations of this, but principally three options. Are you doing this just as a tick box exercise because you have to? So you're just achieving minimum compliance. You've got maybe some high level measurement of those objectives, but perhaps on a qualitative basis, and coming up with a conclusion at the end of the year, pulled together by perhaps by your advisor or certainly somebody in the trustee board or one of the pension officers if you have one. Or are you trying to actually achieve continuous improvement? So rather like a high jumper who sets the bar, gets over the bar and then sets it higher to get even better and better. Is that what you're trying to drive by setting these objectives? But more importantly, is that what you're trying to achieve by setting the measurement of those objectives? And that determines just how detailed the objectives themselves are, but also significantly how detailed the measurement framework is as well. On the other end of the extreme, are you actually looking to drive reselection decisions, or are you looking to consider how much you should pay in terms of the performance bonus, which is driven by these objectives? We do see this, and it really drives just further the detail, further from driving continuous improvement, the detail of the objectives themselves and the detail of the measurement using quant as well as qualitative aspects of measurement to actually achieve that. So what do you hope to gain? What is your aspiration for the strategic objectives? Next slide, please, Jenkins. Okay, I said we'd talk about the framework, and that's what we're about to start doing. So the TPR talked about a balanced scorecard framework. We fed into those thoughts, so fully support that approach. What we do feel, though, is that the level or number of objectives that were being suggested probably was overcooking the egg slightly. What we're not trying to do here is to create a separate industry of measurement of strategic objectives for pension schemes. You want to make sure that you're actually putting a framework in place that is doing the right job for you, for your circumstances, and for your aspirations as well. So we think the balanced scorecard is a good approach. We've learned from our experience of the Dutch market in actually pulling this sort of framework together. And this is principally based around three segments, if you like, of the balanced scorecard. Getting to the ability to be able to measure it to give a total score, ultimately. So starting with factors, and there may be 3 or 4 factors that you've got to start with. Leading then to a couple of areas, or maybe 3 areas for each of those factors. And then related to each of those areas, 2 or 3 objectives. Again, depending on how much detail you want to go into. And factors, areas, and objectives, each weighted according to the importance for you as a scheme, depending on your evolution as a scheme and as trustees. But bear in mind that this framework isn't then set in stone. So it is a dynamic structure, as we say here. So all of these can change, and they will change over time. And the weightings applied to each of those will change over time, depending on what you're trying to achieve at any particular point in your development. So that's the framework that we're aiming for. We're now going to talk about some examples of factors and areas, just to try and put some colour on this picture. So the next slide, please, Jenkins. So here we have a balanced scorecard example, and this is an example that we've worked on with a client who had just recently moved to fiduciary management. They agreed to, we recommended and they agreed to 4 factors, which, as you can read, financial performance, advice, ESG, and relationship. We feel that ESG is an important component of an important factor that should be separate, simply because of the key focus from trustees, the key focus in the industry, the key focus on climate impact and so on as well as making sure that they're considering what members are thinking from an ESG perspective, as well as what is mandatory for trustees. You will see the weightings change from year 0 to year 5 for each of those factors. And the reason why is because the importance of advice versus financial performance changes over time. You'll recall that I said that this was a client that had moved into fiduciary management in recent times. So therefore, the importance of the advice provision, as they got through the strategic advice element of that, setting a journey plan and going through transition and so on to the new strategy, was an essential element of this. And the trustees felt that the advice provision was much higher, of higher importance initially when compared with financial importance. That doesn't mean that financial performance wasn't important, but it was less important in these early stages. I said before that this is not set in stone, and this demonstrates clearly that that is the case. So this evolves over time, where advice, or the importance of advice, ends up being less weighted as you get to the end of year 5, in this case, with financial performance becoming much higher weighted. What we have actually had with other trustee boards is that financial performance ends up being much higher than even the 60% in their eyes. So those are the factors and how they're weighted. And against each of those factors are 2, 3 or 4 areas. And it's those areas that then develop into the objectives that are then measured, which we'll get to next. And again, each of the areas are weighted accordingly, depending on the importance in the mind of the trustees, across all of the factors, whether that's achieving investment objective in the financial performance factor, or whether it's providing appropriate training when it looks at the relationship factor. I'll just pause there for a moment. So this is factors and areas against the framework. So next slide, please, Jenkins. So the next slide then covers examples of those areas and objectives related to those areas themselves. So if you could just click back to the slide, Jenkins, the previous slide, please. So look at financial performance. And the first area of financial performance is achieving investment objective. And then on to the next slide, please. So the first area that we're looking at here as an example is achieving the investment objective. And here we have two objectives related to that. One is to outperform the liability benchmark by X% or Y% over rolling 3-year periods. And the second is management of the assets in line with the constraints in the investment schedule of the agreement. So one is clearly quantitatively measured, the liability benchmark plus, and the other is a simple pass or fail. So a qualitative measure, if you like. And you can see other examples of different areas, again lifted from the previous slide. So provision of appropriate training at the bottom there, where the objective, one of the objectives for that is to run at least 3 training sessions. This is 100% weighted against that objective, and that is assessed by qualitative measure, which is by way of questionnaire. So those are examples of the areas and how the objectives have developed against each of the areas and the weightings applied accordingly and the sorts of assessment method, whether quantitatively or qualitatively, to measure the outcome against the objective. And I'll give other examples of the quant and the qualitative aspects of measurement shortly. Now, before moving on any further, I'll ask Jenkins just to put up the next poll question, if you could, Jenkins, please. So the question is, it's around balanced scorecard approach. Do you feel comfortable using a balanced scorecard approach like this? So there, the results, that's a great result. I hope that means that it's making some sense when I'm talking through it. So 90% thinks that it looks, think that it looks like a good thing to be doing, but needs to be tailored further. And a couple who think it's a bit too complex. I think that the challenge in presenting this in this sort of discussion is that it can, we can get into the weeds and not actually get the message across. I think it's a sense that we're getting the message across, which is great. The tailoring aspect is key. These are examples that we're talking through here, and we have changed and we've tailored to each of the trustee boards that we're working with to develop these. Some are going into even more detail than this. Some are actually reducing the number of factors and just aggregating others into it. But that's great feedback for us on this sort of framework as well.
Peter,
So
I'm just thinking, Peter, when we did this, something similar but not as evolved for the PLSA a couple of weeks ago, there was not quite so many in the top 2 lines. So we're also getting things a bit clearer now. So that's good.
Great. So if we close that, Jenkins, please, and move on to the next slide.
Can I say, Peter, just before you start on the next slide, we are getting some questions from people in a typed form, and we will address these at the end. So keep the questions coming, and we will address them at the end. Thank you.
Thanks, Tony. So this slide and the next slide looks at an example for each of quantitative scoring and qualitative scoring. So this is an example of against an objective, which is to outperform the liability benchmark by 2.6% over rolling 3-year periods. And we have put variations around that in terms of achievement or not of that objective and scored against those variations. And if the outcome is liability 2 plus 2.6 up to 2.9, then we're suggesting in this case a score of 7. And you can see that where you get to score of 10 and beyond and so on, to avoid encouraging inappropriate behaviour by the manager or the advice being provided. We have developed this further when we're actually implementing it, so that it is against the normal distribution of returns, and ragging the scores as well, red, amber and green, to make it easier to actually present when we get to the annual review for trustees. So it is very clear where the outcome is. And we have also introduced and included a way to measure risk in a similar way, depending on the way that risk is being assessed within the objective, so that you've got both sides of the risk and return equation, and able to score that on a RAG basis as well, which is essential. We're also, interestingly, just for your information, seeing some looking at funding level volatility as well, where they've got an objective perhaps to stabilise funding level, looking at what the history of funding level volatility has been, and assessing that against what it is or how it's improved over time as well.
Peter, before you moved off this one, I was just going to mention that if people are interested in the Q&A and seeing a more developed structure of this, I've put it in the appendix, but we'll only deal with it if it comes up.
Thanks, Tony. And then the next slide, Jenkins, please. It's just an example of a qualitative method of scoring. So this is assessed by way of an online trustee questionnaire, where the trustees are selecting a statement that either strongly disagrees or up to strongly agrees on the statement. So in this case, the objective was to provide clear communication and reporting to trustees. The statement being the reporting provided by ABC was easy to understand and so on, and they scored, or they indicated their disagreement or agreement accordingly. And that then gave a score, or gives a score, against which we can also RAG, defining what a 7 would be, which would be green, against 0, which would be red, of course.
Peter, we've used the 0 to 10 score here. Sometimes trustees like to use 1, 2, 3, 4, 5, but we prefer the spikier system. It's fair to say, isn't it?
Yeah, to avoid, as we say here, to avoid people sitting on the fence. And we also have a pass-fail score, of course, where the pass would be a 7 rated and fail would be 0, which is quite straightforward. So what we actually see within the balanced scorecards that we've developed so far is that the majority are actually qualitatively scored, which you would expect, with the minority quantitatively scored. So if I think of an example, we were working with trustees on yesterday, there were, I think, 5 quantitative measures and the rest were qualitative, but gives a good balance, as the balanced scorecard would suggest. Okay, next slide, Jenkins, please. So we have covered a number of things over the last 20 minutes or so. We've looked at the framework for setting and measuring within this balanced scorecard approach. And we've also importantly posed the question that you should be asking yourself, which is what you're trying to achieve from this, given that you have to do it. And that will determine the detail into which you go, and also the measurement criteria that you adopt for your annual review. So in conclusion, before we move on to a final poll question and then questions and answers, we, as well as the TPR, firmly believe that it is essential that you don't have your advisors actually setting and marketing their own homework, just against the whole thrust of the CMA final orders and the guidance from the TPR. So you need to, in our view, either do it yourselves or use your pensions team if you have a pensions team, or indeed have an organisation like IC Select do this for you. We also firmly believe that the balanced scorecard approach is the best and the most effective approach to ensure that you're getting it right. We're not suggesting, as I said before, that you create an industry out of doing that, but we also are ensuring that you must get the objectives right, and you must ensure that you're measuring them in an appropriate way to get the right outcome. Next is engagement with all stakeholders. Trustees need to ensure that to allow them to be agreed by themselves, they have to make sure that they're getting feedback from not just around the table, but from their sponsor, from their actuary perhaps, from their pension team if they have one, but also from their advisor or their fiduciary manager. This ensures that you've got much better buy-in from everybody, but also ensures that you've got the right means to the right end, ultimately. And finally, again, I said before, these are not cast in stone. They will change and they will evolve as you evolve and as your funding level evolves. And as they are measured every year, that should also be a fundamental part of that process, to review what they actually look like and whether they're doing the right job. And remembering that what does get measured does get done. So thank you very much for listening to that. I'll now pass over to Donny, but before I do, just ask Jenkins to put the last poll question up on the screen. Thank you.
Okay, thanks, Peter. So the last question is, do you have an independent third-party evaluator to help you measure your investment advisor? I sort of feel we've now got the answer to this, but do make an attempt to answer it and think about whether that's something you might want to use in future. While you're doing that, I might just mention one other thing about the summary that Peter gave. What we're finding in practice is it's important not just for the trustees to complete the questionnaire, Peter, but also to get the investment advisor to complete the questionnaire, to get their perception of how they think they're doing versus the trustees. And that in itself, in my experience, creates a great conversation around the table and allows you to progress and get the high jump bar higher for future years. 65% don't, and a few do for both the investment consulting and fiduciary managers, but it is a minority, and the same number are considering it. Okay, thanks very much. We'll, I think that's what we would expect. Peter, sorry, I should have left that up actually. I was going to just raise something on that and ask Peter's view before we go into question and answers. I think that's probably what we would expect at the moment. As trustee boards, you weren't given much time, as Peter said, to set these objectives on the 10th of December last year, or ahead of that time. And what's happened since has been a bit like a tsunami with COVID-19 and everything else that's ensued. Trustee boards are incredibly busy at the moment, working with their sponsors and working out how members can continue to get their pensions and they can continue to run. So I suspect a lot of people are thinking this is maybe something we can just kick down the road and we can leave it till later in the year when we've got a bit more time. And the only thing I'd say about that, given our practical experience, Peter, in terms of the clients we worked with last year, it means that you're just delaying the time which you increase the high jump bar. And if you want to actually achieve higher levels of achievement from your investment advisors, the sooner you get onto this, we believe, the sooner you set clear objectives, the sooner you're able to measure success and judge value for money. Any thoughts on that, Peter, before we go into quite a few of the Q&As that I've got?
Yeah, I would agree, which probably won't be a surprise for the audience, but we have seen some trustee boards, again, one I was speaking to on Tuesday, that are running at this actually to make sure that they've not only got the measures in place, but also have their first attempt at what it looks like, what the outcome looks like for a meeting in July. But they're running at it because they want to get that benchmark in place so they know what they're measuring against when they come to look at this next year. and also that their advisor knows what they're actually working against. Not that the objectives are any different from what was already agreed to be done, but just focuses the mind on those specific areas, but in the right way.
Okay, thanks very much, Peter. Thanks, Jenkins. If you want to take that question off, what I'll do is I'll introduce some of the questions that have come before, and actually quite a lot of the questions that have come during the course of the presentation.